Yeah, let's carry on with the boring stocks then. So this was Renishaw's boring report. And the sort of overarching point from them was that order intake from them had improved a little bit. So they said that steady revenue growth is expected to continue into the second half. They said that growth in the Americas and EMEA offset weaker demand in the Asia Pacific region. So in terms of revenues, there's two really sides to the businesses, the manufacturing technologies and the analytical instruments and medical devices. Manufacturing technologies revenue increased 4% for 6 months, and analytical instruments and medical devices declined 3%. Growth in neurological products outweighed by lower spectroscopy sales. All that meant, Steve, was that overall revenue was up 3% to 341.4 million. Operating profit was up 9% to 51.6 million. But if you take it, that was at constant currency, it actually declined 5%. Profit before tax edged up 2% to 57.5 million, with a higher gross profit margin offset by less favourable currency movements and adverse product mix and one-off supply chain costs in the second quarter. Earnings per share increased about 2%, 63.2. Cash flow from ops more than doubled to 51.5 million, reflecting strong cash generation and lower than what they actually planned capital expenditure. Balance sheet looks really robust, Steve. Cash and deposit balances of about 233.2 million. They didn't lift the dividend, so it's at 16.8p share, which is probably all of the fall there, Steve, for you. For the full year, they said PBT, so profit before tax guidance, was going to be 105 to 135 million on revenue of about 695 to 735 million. So I would just urge you to note that range it doesn't seem very wide, but it is wide, because at the top end, that's like a 16% increase in revenue, an 18% increase on the second half of last year. And Renishaw don't have massive visibility on the full amount of products that they're going to be able to make and ship in a year, hence that they've given you this wideish kind of guide. The market thought this report was garbage, Steve, and sent it down 12%. Now, I'm not sure that was necessarily the right take, because it seems to me like Renishaw have kind of just said, all our revenue is going to happen in the second quarter and not in the first. And the market didn't seem like it was willing to wait and see, Stephen. And I think I am.
Yeah, I think with this kind of business, and we haven't covered it for long enough. I say covered quite loosely, but we haven't talked about it for long enough. But if you've been paying attention to Judges Scientific, which is another scientific instruments company, you've seen quite variable demand in different parts of the business there. And what you kind of have to keep your eye on with that is being able to look through a cycle a little bit, or certainly short-term sort of volatility here. And in some ways that makes these things slightly easier investments, in that you can you don't have to kind of constantly wait for opportunities that you think might never appear, because at some point there'll be a difficult-ish quarter where demand falls off, or funding backs away, or inventory gets too high, or something like that. You also know it won't last forever. You need a decent sense it's not going to last for the next 5 years or something in order for this to be a decent investment. But that doesn't look like being the case here. And it does seem to me increasingly like there's a handful of FTSE 250 and nearby companies, so maybe a couple from the 100 and a few from down below the 250 as well, that really do kind of react quite strongly to small fluctuations in things. Renishaw, as you say, isn't the most communicative about these, and that probably exaggerates this effect a little bit. They don't try and smooth things over for investors, particularly by saying, don't worry, we can see. They're not kind of ASML style necessarily, where we've seen kind of orders fluctuate at ASML, but there's always several years of visibility ahead, and even ASML kind of chops around a bit as a result of a stock, and they say they've only got 4 years of backlog ahead of them now, and the market thinks, oh no, what are we going to do? We've only got 4 years for this to something to change in the geopolitical environment. Well, maybe it won't. Maybe it won't. But yeah, it's kind of worse for Renishaw, and that's why you see this chopping around, I think, in these cases. It wouldn't worry me. It didn't look like a wildly underpriced stock before, but a 12%. It's difficult to kind of get inside the mind of someone who liked this 12% less after the report than they did before it, I think.
Yeah, I agree with you completely there, Steve. I just thought Renishaw, basically, this report is, and look, it does go. It's probably worth us saying that the sort of founders of Renishaw are older guys. The rumor is that they're ready to sell, whether the business in whole or sell their share to somebody else who wants to take it over and run it. That's on the sort of like tip of what they want to do. Um, so, and that comes across in the earnings reports, whereas they're kind of like old hats who've been running this business for a very long time and they know exactly how the business works. And they're not going to sugarcoat it for you. They just say the truth. And the truth in this occasion is we did okay in the first half, a couple of percent here, a couple of percent there. The growth is going to come in the second half, maybe if we can get it all done. And that's essentially what Renishaw are saying there, because remember, if they don't get it all done this year, those orders don't disappear. They just go into the next quarter. So it's just about you. You've got to be patient. The only advantage you have as an investor over everybody else, all the big funds, what have you, is being patient. And I think that's what Renishaw is asking for here, and they didn't get it.
No, and you're exactly right. I mean, we get to the end of the reporting period, and maybe it's the year or so. Okay, so your year-end results don't look great, but there's two things. One is that can hang over to the next year, and secondly, it means that you can be up against pretty weak comps the following year. So suddenly, the people who have started looking at it in the last 12 months or so start seeing enormous looking jumps in numbers for two reasons. One is that you've got backed up demand a bit, and the other is that you were previously looking at kind of held over demand. And both ways round, that can look deceptive with these kinds of businesses. In general, I think of them as kind of they're kind of precision measurement stuff, Renishaw, right? So there's lots of different equipment manufacturers for stuff that we've been looking at over the last sort of year or so, I think. But yeah, markets can be timings of sales can be important here, and ultimately probably this wears out if you have a longer time horizon, I think. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.